All right, so welcome to what is going to be the last open to the public live session, other than kind of a general brief one we'll do once a month, kind of a macro overview type of thing. Not too in depth, but enough so people kind of know what I'm thinking. Starting with actually another one later this week, Wednesday. It's going to be subscribers only. So if you are thinking about joining this really cool, little eclectic group of serial learners, if you will, um, and having me kind of introduce things like how to use options simply without exploding your brain, and how to use technical analysis to tell you what the market really cares about, as opposed to what talking heads think you should care about or tell you to care about. So, and we're going to continue to do fun stuff like this, which is what I call a ticker parade, where I've invited people to give me specific tickers. It was kind of like the old radio shows. If you remember Bob Brinker, or down here in South Florida, we've had these, and I've always wanted to do this. Um, am I going to give you a 10-minute dissertation on every ticker? No, but I will certainly take any follow-up questions, whether you asked about the ticker or not. I'm going to try to size these up from the standpoint of the chart, my sort of instant read. I did not review most of these beforehand, because I want you to see it as a pure technician does. And we can always go back down a level and say, okay, that's what the chart says. Can we understand why? Is there a real world corroboration? I actually recorded something a few hours ago for the first time. I think we're going to do it once a month. Seeking Alpha has this great new group, people who are in charge of, I think, trying to draw a little more attention to what we investment group leaders do, and also focus on ETFs, which have not really been a huge priority at Seeking Alpha, but I think that's where a lot of the industry is going. Stock picking is not going away, but ETFs are being used for so many different things now. There's so many different varieties. So I was thrilled when they asked me to be one of the first guests on there, and I guess to be a regular guest. So all right, so we're going to get in the ticker parade in a minute. I thought that before we do that, I would just give you a couple of quick thoughts, including the completed, still in draft mode, version of what will soon be this week's threes report. That's our broad report, and once it goes through our editing department, otherwise known as my wife Dana, we will put it out, probably sometime first half of tomorrow. Okay, so we'll get to the ticker parade, and hold on here. Okay, there's a reason that this little guy, cute little guy, is there. I'll come back to that in just a couple minutes. First, this kind of caught my eye. I'm sure I'll write about it pretty soon, but we have reached the point finally. It's taken, I think, a couple of decades, but half of US private sector workers are now saving in 401k plans. Okay, that is fantastic and freaking dangerous at the same time. I know that's not an ordinary combination, but these are the types of things, like when everybody is involved and, dare I say, it starts to seem a little easy, that is when secular shifts tend to happen. It doesn't mean they're going to happen tomorrow. It just means we're getting a little closer. And I will show you some other signs of that as we go through. Here, I'll give you a quick little brief run through of the threes report. Okay, you ever heard of what do you do with the drunken sailor? I think it's like a 200-year-old, song that they used to sing at sea. Well, my version is, what do you do with a drunken market? Um, the market is certainly not it's not shy, it's not unexciting. If anything, investing has kind of become a sport. That is always a little bit of a concern to me. As I say, we kind of have this wash, rinse, repeat lately, which is reacts to a sell-off, tariff news, whatever. Hey, here, Dan, I help you out. Decide it's not such a bad idea, and then climb back to where all the calamity began. I'll try to point that out in the charts. If I don't, remind me. And it's a really lousy scenario for long-term investing, because it's really hard to find things that go up and after a little bit of a pullback go up again. We have some, but they're in the past, and we're looking forward. Okay, and I'll show you some charts like that too, because some people asked, I think, about some that look that way. So, but it is I think, a very opportunistic one. I think a historically opportunistic one for what I call renting instead of owning, or tactical investing, and not buy and hold. I'd love to be a buy and holder, but just aren't enough situations where I feel comfortable that way. The dog collar strategy that I'm happy to hear people are thrilled with, and so am I. I'm going to be doing even more of it and reporting on more securities, whether they own them or not, because I couldn't possibly own a collar on all the different decent looking securities I see. But what it is doing for me as an investor, it is making it so that I don't have to be quite as tactical. I can plant my feet into something that is longer term in nature, aims to be longer term in nature, but I don't have to worry about the biggest issue with long-term investing, which is you start with $100, you say, okay, over some number of years, 5 years, 7 years, rule of 72, you double your money at a 10% return in 7 years. Great, in 7 years, I'll double my money, I'll be fine. You're going to turn $100 into $200, but too often the route from 100 to 200 goes through 80, 70, 50, or sometimes even 30. And that, to me, especially at this stage of life, I don't want to wait 5 years just trying to get back the money I just lost. So that's my personal take on this. And using options is a low risk surrogate for buying stocks and ETFs. I will either today, certainly on Wednesday's session for subscribers, when I'm actually going to do a live trade. I'm going to set up a collar. Not sure which one it'll be yet, what security it'll be, but I'm sure I'll have one by then, because I have plenty of ideas just about ready to go. And I'll do one of them, live on the session, and walk everybody through it, and answer any questions as we go, because I think that will help demystify some of the parts of that dog collar strategy. And if you're not familiar, what is a dog collar? You take a stock that's really a dog. It's been way sold off. Probably not as many enthusiasts around it as there have been in the past. So it's a comeback story. It's a contrarian idea. But rather than stick my neck out, because I don't like to do that, I will pair it with a put option at a price underneath, strike price underneath, sell a call option on top of it to help pay for that put somewhat. And now I have myself a range. I can't do any worse than this, and I can't do any better than this, except that I just have to do a little more work, buy more stock, etc. So I kind of think of it as I'm eliminating virtually all of the things that can go wrong in a big way. And what's my number one investing rule? Is people who follow me know, ABL, avoid big loss. So if I can first avoid big loss and then give myself full upside, sign me up. All right, so let's see, I've got a few charts here. I'll just quickly review them sort of in nature. It has been a long time since high dividend stocks have been competitive with the S&P 500. That was not always the case. They used to be more cyclical back and forth, but there's so many things now. Value stocks, small caps, international. I mean, everything sort of bows to the S&P 500. So, and what is driving the S&P 500 in many cases has been the Nasdaq. But I look as a technician. It's not just the price charts of the stocks themselves. It's just looking at little trends. Now, look, this is a baby trend. It's not a daddy or a mommy trend. Okay, but a baby trend. But this is what I see, and it's kind of harder to see it here. But okay, this goes to sentiment, level of excitement. It wasn't that long ago that the 1 year trailing return coming out of the pandemic for the Qs was over 80%. It was like 85 something percent. And of course, 2022 was a train wreck. And now, for about the past year, after peaking at a little bit over 40% for a 1 year total return on the Qs, we're approaching 20, but not just approaching 20, but we are steadily coming off of that. So I'm not looking at anything other than what was the 1 year return here? What was the 1 year return here, here? And over time, as you see, especially in this kind of pandemic, post-pandemic market, it tends to go in waves. Doesn't mean anything yet. It's just one of those things I kind of put on my radar. The other thing you can say is, when it comes to the 5 year total return, which is what we're looking at here, and this is not annualized, this is a total return. Well, we peaked out after the pandemic at a 5 year NASDAQ return of over 240, almost 250%. It crashed in 2022, but was still pretty hefty, still over 60% over 5 years. So people were thinking of it as, oh, okay, well, no, I lost money, but I only lost money I'd already made, so I'm still way ahead. Well, again, we'll start to see. Does this become a psychological factor? Do people have, as they like to say in the crypto world, diamond hands, or I don't even know what the others are, lettuce hands, leaf hands, I don't know, something, weak hands, okay? Can people put up with not getting the instant gratification that they are used to, okay? So that's a little bit of a preview. Whole thing will be out tomorrow. And let's go back and let's go to that ticker parade. And what I'm going to do now is, okay, so first, I've got the list here. Okay, thank you for all the ideas you put in. Some of these are from folks who are listening to this. Others, somebody brought up a very good point, said, what about other high yield stocks? Because you're getting a lot of the dividend income that helps pay. It's like a second set in a collar. You're paying for the puts. How do you cover the cost of the puts? You can sell call options on top of that. It'll defray it a bit, but puts tend to be more expensive than calls most of the time, is sort of all things being equal. But if you're getting that dividend income regularly, it's just another source of revenue, if you will. And I think of this like a business. So I'm getting two sources of revenue. I'm getting dividend. I'm also selling the calls, bringing that in. My third source of revenue is if the stock goes up, and the only real cost is a little bit of bleeding room for the stock, and the cost of securing the protection underneath it with puts. So I'll sort of intersperse that as I see good situations to mention, hey, that might be a good collar, or that would be a terrible collar. Okay. So why is this guy here? Well, that's ET, and ET is the first symbol. So I figured might as well add a little bit of levity to it. All right, let's go and bring up Let's see, we should be able to see this now. Actually, I'm going to do this a little bit different. I'm going to move this over here and let's go and look at that screen. Okay, so now we should be sharing this screen. And let me try to get the charts back up. Okay, we should all be able to see this. All right, good. So let's start with the aforementioned ET. And I can't help myself. Dana knows this after being married to me for 32 years. This looks like one where ET is getting ready to phone home. That is what I would call a toppy chart. It's a toppy chart. If I look back a little bit further, yeah, it's got some room. And by the way, this is Energy Transfer Partners. It's one of many. I guess they kind of refer to these as the toll collectors of the energy business. You know, you drill for oil, you transport it, and it gets used somewhere. They do the transporting. So you know, it should be the relatively lower stress, higher yield part of the energy sector. But this says otherwise. Anytime you can see something go from 30 some dollars, there's a 90, that's a 90% dip there. Okay. And here's another one, you know, similar in size. So, and granted, the higher yields are not in this chart, but I tend to believe that these are things that you buy when they are really, really out of favor. That is not the case right now. So this is one that I don't love the looks of. And anytime I see a 20-day moving average, which is going to be in yellow here, when I see the 20-day moving average start to roll over like that, one of two things is happening. It is either a good sign, it's rolling over just a little bit. You see this pattern all the time. Rally, go, pull back, rise. I think they call this like a J formation. Right there is the letter J. And I'm a big fan of that formation when it happens, but you know, it happens until it doesn't, and then it can, you know, quickly roll over. Okay, so that is ET. Let's move on to the next one. And what I'll do is I will race through the ones that you all put in, and then I'll take a quick break, see if we have questions, and then we'll go ahead and I can add in some more of my own names to, you know, that I think are topical. Okay. All right, let's see. Next is JP Morgan. Well, the first thing I notice is, I mean, the pattern is somewhat similar. There's a lot of stocks. There are a lot of stocks that look awful, and there's a lot of stocks that don't look awful yet. But what catches my attention is that the PPO, which is my favorite momentum indicator, is you know, it's up there. It's up there. So it doesn't mean it can't keep going. But I don't know, you know, should a bank stock go parabolic like this, even if it's, you know, the mighty JP Morgan? I mean, certainly we have removed from the headlines all that stuff about regional banking crisis and all that. JP Morgan rescued a bank to stop a much bigger calamity from spreading. But, you know, what I see here is a really powerful uptrend, which will go until it doesn't. Now, this happens to be, I mean, it's not at the top of my collar list, okay? But if someone said, well, could you collar that? Yes, you can collar anything. But what I would look at is, okay, it wasn't long ago. Here, I'll look at the weekly chart over here, okay? Where JP Morgan would have been interesting to me, but it pays so little yield, and I've been, you know, focused until very recently on insisting on having a higher yield, but I think that ship sailed. I'm kind of more open to looking at things that don't have high dividend yields now. So when it broke through here, multi-year high, and really started to accelerate and came up from this zero line here. So I would say right in here somewhere, this started to look pretty good. The weekly version of the 20 period moving average here had also turned up and went from kind of, higher and flattening out to going even further. So this might have been the time where, if I had had my head in the game on JP Morgan back then, that I might have looked at it around here somewhere and said, everything to me is about not just what I'm going to own, when I'm going to own it, and especially how I'm going to own it. And how I'm going to own it, in this case, if I had decided collar, this would have been an interesting time to step in, because if it breaks back down below here, it's probably not going anywhere. I'll know quickly if I'm wrong. And that's all I can lose, some number, I don't know, maybe 5%, 6%, 7%, something like that. That's usually where I set the downside. But I have lots of upside. And what would have happened is I probably would have been forced to sell the stock here or make a change to the option collar to allow me to own more stock or buy call options or something. So that's, to me, if something is going to go parabolic like this one did, a collar is a great way to use it. Now, does that mean that I would never buy JP Morgan outright? Well, I would, but most likely what's going to happen, me being the chicken blank investor that I am, the risk manager that I am, what would happen is I would say, okay, yes, it's starting to fly, but I don't want to own more than 2-3% of my portfolio, maybe at most 4% in this, because I don't want to be in anything where I own, let's say, 3% of it, and it drops by 15% on earnings overnight. Okay, that's a 0.5% impact on my portfolio. 3% times 15% down, 17% down, it's about 0.5% on the whole portfolio. I don't like dealing in those numbers, not as a risk manager, not as somebody who's trying to bring in steady returns, low standard deviation, as much cash flow as I can get. So I look at this as, all right, I could own JP Morgan or something like JP Morgan at a 2% position or something like that. Or if I collar it and I know I can't lose more than X% because I've defined that worst case, I can now own a much bigger position. I can own 6-7%. Doesn't matter to me because I can't lose more than X% on that position. So that to me is kind of the powerful thing here. And let's see, because I have a feeling that the explanation I just gave you on the very well-known JP Morgan is probably going to be a similar situation to a lot of other things that we look at, because the stocks that there are really two main types of price charts I see right now. I see a lot of this, and I also see some that just look like, they're already dead. It's just a matter of how dead they get, if you know what I mean. And I will point those out as we see them. Okay, next one. And when I saw this name, I thought, okay, I have been thinking, well, maybe there's a time for China. Okay, maybe there's a time for China or Hong Kong or something like that, and maybe it would make a great collar. Now, this one, okay, which is the huge semiconductor company over well, technically Taiwan, China, but this the chart does nothing for me. I mean, it just looks kind of stagnant. However, it's been a long way up, and certainly if you own it, I mean, look, this is a case where if I owned this and I made a lot of money on it, I might be collaring it here, because let's take this example. Let's say I was fortunate enough to own it, I don't know, anywhere in here, okay, in the low hundreds. But now the stock's up here. What a great time to say, hey, you know what? I am going to say I want to let's say I want to make it so that no matter what happens to this thing, I can't do worse than 195 on the way down. And for that, maybe I cap my upside. And you can continue to do this all the way through with this or a JP Morgan. You could have done that all the way up, just kind of playing chicken with the market and always defining your downside. So it doesn't do much for me because I tend to be biased against things that have gone straight up and I've not been involved. I would rather get in the earlier innings, if you will. Okay, let's see what Uber looks like. Somebody had written to me about this recently, and I said, yeah, I've been taking a close look at it. Earnings came out and poof, earnings came out and, it was gone. It doesn't look nearly as good as it does. This, however, is one that if I had to do it over again, I would say, earnings are coming up. This is part of the Dow composite. I like Dow stocks, mostly industrials. The composite is sort of the close cousin. And I could have tried to collar it in here. What I don't like to do is guess with big money on what's going to happen when earnings come out. Because depending on the markets, not even so much on what the actual numbers were, if the market liked what it heard, it can do this and it can spike it up, 8-10% in a heartbeat. Okay? If the market didn't like it, maybe it trades down here and I feel like an idiot. Okay. It's easy enough for me to feel like an idiot as an investor without the market, helping me. What do you call it? Unforced error as opposed to forced error. Okay. So that's that. All right. We'll speed the pace now. Amphenol. I know the company. I'm not too familiar with it. And I would also say, look, this is the type of thing we see all the time. That's what I call fake out breakout. It's great that when flying, I don't know if this is before earnings or after earnings. And now it's right back down to where it was. And there are a lot of tech stocks that are starting to look like this. It's gone nowhere in, what is that, 8 months? Just about 8 months, gone nowhere. So it's almost like the market is exhausted and tired of tech stocks. Okay. That is part of my theory, which I expressed on the interview with Seeking Alpha earlier today, why I think gold may be running a bit. All right, let's go to a more familiar name for a lot of us, Union Pacific. Somebody asked about Union Pacific, and there are a few of these in here, but let me tell you why. This looks like almost every energy stock that I look at. In fact, because I don't think it's on your guys' list, but it's on mine. Okay, so there's Union Pacific. Let's do a little bit of chart association here. Okay, what do I see in Union Pacific? I see a trading range, good for traders, lousy for long-term investors. Dividend is modest. I don't know, this one's probably in the 2.5 range, something like that, if I recall. Okay, but a very tradable range. That's 40 points up and down. It's over 15%. You kind of have to move quickly. You've got a few months at a time, but this is what most of the market outside the Mag 7 is turned into, just a lot of this. And so it's also why I think past performance, especially the way I see a lot of the TV media use it, is just really garbage. If you were trying to sell somebody on this stock, you'd say, hey, look at this. It just had a 15% move in no time. Great. What did that do? It brought it all the way back to where it was here and all the way to where it was here. Longer term, of course, the stock has gradually moved up, but once again, so many stocks that look like this, okay? The non-headline stocks. It's trading at the same price, again, puny dividend. It's gone nowhere for 3 years. And when it's chopping like this, you either have to trade it, in my opinion, or you have to move on. Yeah, maybe you can sell covered calls on it. Some people would probably be quick to say that, but I'm not a big fan of covered calls alone because and ETFs that do that because you're saying, okay, I'll exchange a little bit of upside in the form of the cash flow. I cap my price upside and I cap my downside. Oh, wait, no, I don't. Not a lot anyway. Okay. If you are getting a covered call dividend, covered call premium here, and the stock goes down quickly by 4%, you just lost plenty of what you just brought in. To me, it's an overuse. It's not a bad strategy. Okay. It's an overused strategy, and it's often an incomplete strategy, covered call writing. I like to collar because then I get to define my downside as well. And there's so much more you can do from a position of strength when that happens. Okay. So does Union Pacific look anything like this? Obviously, different prices. Okay. Yeah, it looks a lot like CVX to me. The other energy stock that I was kind of looking at closely for a while was EOG. It's a little more volatile, but so what? It all looks the same. Just out of curiosity, I didn't look at ExxonMobil, but does it look the same? No, ExxonMobil looks a little bit different. Right? Don't know why. Don't follow this one too closely, but could very well be a different type of case here. Okay. All right, let's see. Moving on to an intriguing sector here, Blue Owl Capital. This is a what they call a business development company, BDC. Essentially, what they do is make loans to commercial borrowers, not tiny companies, but don't necessarily have to be the biggest. I mean, multi-million in revenue, type businesses, but kind of like if you will, a middle market lender is a lot of their activity. So it's like a public stock that is sort of rhymes with private capital. That may not be the best definition because I've never owned one of these in my life. I will say that looking back, I'm sure they would have been great for several months, even a couple of years here. What I see that I don't like over here, just looking at it pure technicals, is this. That to me is a sign that the chart may be getting a little bit exhausted. Is it a little bit or big bit exhausted? I don't know. The last time it topped out around here, 19 went to 16 or so. It's about 20% dip. This one's already down a little bit. Looks like what, about 7-8% already. So again, if I look at this and I say it's sort of in the too tough category. Okay, is it going to follow? Look, charting is evaluating reward and risk and the trade-off between them. It is not predicting the future, and it is not saying buy this with all your money, and it's not saying don't ever touch it ever at any price. Okay, so I look at this. This is simply drawing the market's memory. Okay, and if you don't think algorithms are not looking at these types of things, not to mention people programming those algorithms, okay, very popular right now. And that's why I used to just amaze my interns back in our advisory days, because I would say to them, I would draw a line like here and say, here, this is the decision area. And it would go there, and wouldn't you know, it would bounce right off. How did you know that? Well, I didn't know it for sure, but this is what the market is thinking. And I didn't draw this exactly, but somewhere in here. Okay. So if you see it continue to go and touch and touch and touch, well, it is a rising trend, right? It keeps ending up higher than it did before. The highs are higher and the lows are generally higher. But at the same time, this also can act as a place where you can say, hey, wait a minute, if it comes back down to that same level, if I kind of use my mind's eye, as they say, if this little rollover continues, well, then maybe it gets back down to somewhere in the $20 range. So, I'm risking 15% right now. Yeah, like a lot of these, it's undecided. Uh, if I owned it, I would probably call this a solid hold. I don't own it, never owned it, followed it just a little bit. And but this would not be a buy, and it would not be a sell, which is why a lot of my articles on Seeking Alpha piss off some of the audience because um, I don't look at it as buy or sell. It's not a binary decision, and it depends on what the circumstances are. I would also say this: if I had bought, oh, I don't know, a 4% position in the stock at $15, and now it's up here and it's, I don't know, 5-6% of my portfolio, good chance I'm cutting it back, because that's the other thing you can do, take a profit. And so I'm trying to blend as much strategy in here as I can. Okay, let's see. I'd never heard of this one until today. It's called NVIDIA. No, just kidding. I've even written about a horse with the name NVIDIA, except they took out the I, a racehorse. And if you saw his first race, you'd be like, oh, that kind of looks like the chart of NVIDIA lately. He was all over the place in his first race. It was so funny that I actually put out the video as part of the article. So NVIDIA, the stock, the only stock that a lot of people cared about for a while, it's in a little bit different zone in its long-term path here. Okay, so obviously I look at this one quite a bit because it tends to be a good measure of market mood. What do I see here? I see a lot of things going on, but none of them are really that critical right now. One of the things I see going on is this is what I call counting backwards. Okay, I've written many articles in the past where I just said, here's why I'm counting backwards. Okay, stock's at 133 and change close today. So it's basically where it was about 8 months ago. Okay, so I mean, there are, believe you me, okay, when we're going back to the JP Morgan and the other stuff with the parabolic moves. Okay, one reason I tend to avoid parabolics is that it too often you're buying yesterday's news, technically wise. Okay, if you have a fundamental edge, or you have some technique or valuation, whatever. Apple was selling like 9 times earnings, I don't know, maybe 12 years ago, something like that. And it was a steal at 9 times earnings. Guess what? It was still a steal at 13, 14 times earnings, as it turned out. That doesn't always happen. And so when I look at this, I say, okay, NVIDIA, wow, everybody's made a fortune on that. No, if you bought it 8 months ago, you made nothing. And if you bought it because you had just heard about this wild company that's ruling the world, okay, with this really cool, CEO who, does strange autograph sessions. Those of you who know what I'm talking about. You also have something where you could have bought it at max hype and you'd quickly be down 10%, formerly known as 20%, before it rebounded. So that's also what I see here. I see a lot of indecision. This is very trendless. Can it go back and get to the old high? Absolutely it can. The bigger issue is going to be busting to a new high. Okay, I was talking about gold before. Gold, so what? I'll save gold because I'm gonna bring up the chart on that. Okay. So anyway, to me, trading range, maybe a bounce. The problem with trading ranges with this, or let's see, I'll go back to this one. This is one of the last stocks I sold off and decided not to collar. Here's the problem with the collar. You're, other than the dividend itself, you're paying a little bit for the privilege of the collar. The put generally costs more than the call brings in, unless you really want to limit your upside. Okay. So the one thing that you don't want to happen is because if the stock, let's say I went in, I'll just move this line up for these purposes. If I went in and, collared this, I don't know, just to pick a point, like right in here, and it fell this hard, well, wherever my put strike price was, that's the maximum I can lose. It's going on with Merck right now, which I'll bring up before, okay? Once it goes past this threshold, I can't lose anymore unless I do something stupid like change the position in a way that would leave me more exposed than I was. I basically made a contract that I can only lose a certain amount on this stock. The problem with this is if this starts to happen, other than, yeah, I mean, you can refresh it at a lower level, you can make money on the put option as it goes down this far, the call option will expire worthless, so you keep all the premium you brought in. These are, sort of little advanced points that I'm sure I'll talk about quite a bit or answer your questions on anytime. But when you see it, when you see it range bound like this, you have to be very careful because stagnation or just kind of up and down leading to nowhere in a stock price does not make a good collar because it's just taking up time, and the options, while it's helpful that they're protecting you, they're not making you any money. So in order to collar something, I really, really need to believe that it will go up in the next 1 to 3 months, like start to really move higher in, earnestly, not temporarily. That can be a stock that just has a brilliant pattern, and I like it otherwise, fundamentally and all that. Or it can be the other type, and I've done a couple of these recently, where I said, let me just kind of take a shot with this one, because it could really fly as it gets rediscovered. A lot of these are contrarian names. And if it doesn't fly and it gets crushed, I can only lose so much. It's a very good reward to risk trade-off. Okay, so let's see. That was NVIDIA a long time ago. Okay, let's see. Palantir. A client back, I had a client back in the day that was an early holder, and PLTR, right? Blanking on the symbol here. Okay, one I haven't spent a whole lot of time with, and you can see how thrilled I am to have not been a part of it. Not very thrilled to have not been a part of it, but this, you could almost, except for the gap here, okay, you could put JP Morgan here, okay, and different percentages involved. But again, this is a very strange market in that I'm showing you some of the good ones, okay. A couple from now, I'm going to show you some that look the opposite. And you're going to say, is this the same market at the same time? Now, what's happening with Palantir right now seems to me, again, as somebody who doesn't really follow it that closely, but it seems to me that it's almost becoming like the new, the new okay? The new NVIDIA. This is the one that, everybody gets excited about owning, and, it's going to go to the moon, etc. And you know what? Maybe it will, but I am allergic to parabolic stocks. Now, the other thing I will say is, if I were going to try to participate in this, I might do it similar to the way I am doing right now with gold. And once again, I'll tease you on gold and come back to it. Plus, you don't have years of history here. I will say this, okay, this is another one that would have been in the zero return club, because from January of 21 until late last year, it had gone nowhere. And so while this is wonderful, remember that every one of these, just speaking technically, I'm not trying to evaluate the business or anything like that. Okay, but technically, every one of these started with one of these. Okay. This is not the first parabolic move in this stock. It's just the one that's getting the most attention because, the market cap's flying and all that. Okay. Brilliant company, obviously. Very, I would say, popular CEO. Very, very kind of matter of fact, right? I think Alex Karp. So, look, there's a lot of reasons to be excited about what it's done. But it's kind of a runaway train. And so, yeah, this is one that I don't know, the options are probably outrageously expensive, but this is one where, maybe I would look at a cheap option, kind of like, hey, I dare you to go up another, 20 points in the next few months, that type of thing. And you either lose a little bit of money or you make a ton. That's kind of how I look at those. Okay, another one. And another one I'm not too familiar with. I mean, obviously I know it's a tech company. And this one kind of fits that same pattern that I talked about before. I'll just put the lines around it. And I mean, in a lot of places I can draw this, but I'll draw it to the last low there. Okay. It's another one that looks, chopped salad over here. And has been volatile. Hard for me to do anything on a technical basis based on this. And so, that's where everybody having their own fundamental and other biases. If they think they have a knowledge edge, great. Technicals will just help control risk. Somebody asked about Bitcoin. I'm going to show this one, but I may peel back to one of this is the biggest Bitcoin ETF from iShares, no surprise. So it's funny, on the gold session today, they asked me about it a bit, and they said, "Hey, is Bitcoin the new gold?" And I said, maybe it was for a while, but gold looks a little bit better to me than Bitcoin does now. Once again, you're sort of in this, okay, it's in a bit of a trading range, but I'm going to go back a little bit further using a different, actually, you know what? I'll use the Bitcoin price itself. Even better. Let's see, I'll look it up here. Well, I guess they changed the symbol on me. Yep. Okay, let's see. Where is my spot Bitcoin? Did they take this off here? Maybe they did. Okay. Just look down this list and see. Ah, there we go. Okay. So, I mean, applying technicals to Bitcoin is potentially a exercise in futility because there's so many things that drive it. That said, a lot of technicians around Bitcoin, because what else are you going to value it on? The distant future, the future of the blockchain, the supply demand, the halving events. I mean, I'm familiar with all of it. What I see here is that this is getting compressed, and when you start to see something like Bitcoin behave this way, I don't know where it's going to go. I just know it's going to be a violent move in one direction. It's either going to be down through here and maybe retrace some of this, or it's going to be up through here and it's going to be the next leg higher. I would say that once it makes up its mind, it probably goes for a while, but you can only imagine, the old way they used to describe technical analysis was, well, there's a lot of people who bought into it here in the 70 range, okay? And so when if it were to fall back down to here, they don't want to lose money, and so they'll sell out when it dips below 70. That was the original way that support and resistance levels, as they call them, came to be. But that was decades ago, but people follow those same rules. So Bitcoin is not really something I can say, I have a very strong opinion about. I was looking at Ethereum recently, and another example of why, you try not to mess with things that you don't know that well. And I certainly don't know this very well. Is it a collar possibility at some point if the options are cheap enough? Maybe, if it continues to obey this range the way it has been, but right now, it still looks south. But the trading range is so wide. I mean, that's, a little bit short of, I guess, a little bit up here. Okay. I mean, that's almost 100%, 90% trading range from top to bottom. Very enticing if I can get it the way I want to get it. Okay. All right. And then we have one more on the stock side, and then I'll stop for at least a moment. And this is somebody who asked that really good question. Why not these stocks with higher yields? Because you're getting the dividend. Well, part of the problem is that this is trading like that dividend is in trouble. You don't see stocks fall like this unless there are much bigger problems. This is one I was in, I think, briefly last year, but boy, I bailed out early. And if I told you the number of stocks, I mean, I'm probably much better at avoiding loss than I am getting, earth-shattering gains. If I showed you a bunch of stocks, in fact, maybe I'll do a session on that, like, how I avoided big loss. I mean, 20 times. I have so many stocks that I have owned the last couple of years where, I don't know, maybe I owned it while it meandered. It didn't get anywhere. And I said, okay, I'm going to move on. I saw it dipping lower. And the next thing you know, wham, down 20, 25%. And it's relentless. There is nothing interesting to me here. I would have to go so far back, it probably is not even relevant. And again, I don't do a ton of long-term charting, but again, markets tend to have a memory, okay? These were kind of crisis periods for this thing. If I were really trying to convince myself not to buy it, I would say, Rob, okay, if this thing follows the long-term pattern, this thing could be south of 50, no problem. That could be a 40% drop right there. I'm glad we're recording this, so when it goes to 250 in the next 6 months, people can say I was just a gloom dumper, right? Okay, so let's stop right there and see what other questions you have on the chat, on the microphones open, etc. And I will finish up with a few others because I think they're good examples, but I wanted to make sure that we could have a break here so you guys can catch your breath, let your eyes catch their breath. Can I explain anything further than what I did, or do you have additional tickers?
Yeah.
Rob,
Oh,
can you?
wait. Okay, I heard two people. Paloma, you are first.
Okay. Hi, how are you? Good
Okay.
evening.
Hey, good to see you again.
Yeah, good to see you. Listen, I forgot a ticker that it's a stock. I read a very good review, but that I don't know very well. It's called Seagate.
Mm-hmm.
Is STX,
Yep.
and it's a technology and data center.
Yep.
And I am underwater. And I don't know why I bought it, but the fact is that it's in my.
Okay, well,
So
it's all
I just
relative,
I
right? By the way, I am old enough to remember, because this is one of the very first stocks I think that my dad mentioned to me. And that would
Yeah.
make sense because he was like Mr. $10 and under. Okay. So my guess is he was probably looking at Seagate. I don't know. We're back here. Um, it used to trade as SGAT, I believe. I don't know if anybody looked that up, but I remember Seagate as SGAT, and I think they were a Nasdaq company, and then they relisted New York. So anyway, okay. Well, welcome to the modern stock market, Paloma and everybody else. What have we talked about quite a bit? The idea that it's easier to make 10% in 1 or 2 or 3 months than it is to make 50% over a longer period of time. And you're kind of seeing it here. And I mean, look at all the little moves here. Okay, this is why I'm kind of a renter and not an owner. In fact, I'm going to draw something else in here. Okay, and yeah, it just looks like I'm just drawing straight lines on a chart. But what I'm trying to show you is how market prices manage to move these days in a market that uh, has had one of the best 10-year runs in history, but it gets to the point where in batches, stocks start to sort of fall off the wagon, if you will, leaving very few that are still reliable and inexpensive. Find me quality, reliable, inexpensive, and good chart pattern. Not very easy to find, which is why I went the dog collar route to say, hey, I don't want to stop investing. And I don't want to have to take teeny tiny 1-2% positions like I was doing last year. I need a better set of rules or better set of guardrails on this. So that's the Seagate chart, and you can see, pardon the pun, that I mean it's had plenty of runs, but at the end of the day, it kind of goes nowhere. And if we want to stretch this back out, okay, I'm going to do a reprise or an update on what I call the zero return club. Seagate's got a little bit of dividend, last I checked, but price wise, I mean, yeah, it's $97. Great. It was $97 4 years ago. It's 97 and 98 now. There's nothing technically here that makes me think that it's going to do anything other than go nowhere or eventually roll over. That doesn't mean you can't get a spike up to here. Now, that's not the only way to look at Seagate. Okay. I will pull away from the investment part of this, and I should say the technical part of this. And if anybody would like me to do some sessions on this, especially now because we're kind of going to, hey, you need to be a subscriber in order to attend most of these sessions. Well, I could certainly do a nice primer here on how I use these factor grades. I think the Seeking Alpha factor grades are excellent. They're not infallible. With a little more research time, I'll probably do a couple of my own studies on these things. I already have come up with my own blended factor grade using the things that I like. So this is a whole like open discussion. So when it comes to Seagate, okay, interesting. You don't see too many A pluses for valuation and growth. And apparently people are high on it. I'm guessing there's an AI story here somewhere, if I had to guess. But I start with profitability. I want companies that are sustainably and reliably profitable because that gives me two reasons to not care about a recession. Let me just check here. Yeah, it has a 3% yield. Dividend is borderline safe, not bad. Dividend, I don't know. Sometimes I wonder where the dividend growth rates come from because it doesn't have a very strong. Well, it looks like they probably knocked out their dividend and then started growing it again after this. A lot of companies' dividend policies were just ravaged during COVID. So, I want companies that are profitable and companies that have good chart patterns. And to me, the recession resistant part of this is if we get a recession, I want a company to be able to fund itself and not be borrowing or forced to borrow. There are something like, I think out of every 5 companies on the Russell 2000 small cap index, 2 out of 5 need to keep borrowing just to stay alive. And if interest rates stay high the next year or so, we're going to run into what they call a debt cliff for a lot of these folks, these companies, where they will have to borrow or refinance. I think it's called a refinance cliff, refinance wall, I believe is what they call it, where they hit the wall. And it's like, oh, okay, we're going to just roll over our 3.5% low or medium rated debt to 3.5 again, right? For another 10 years? Nope. It's going to cost you 7. It's going to cost you 8%. Well, just the interest cost. They're not the U.S. government. They're not the Treasury. They can't print more money. They're a business, and there's a lot of companies going to have this problem. So when it comes to something like C8, I guess for me, it wouldn't get in the door because of the C plus rating. And again, I'm no expert on fundamentals. Balance sheet income statement reading, not my forte. Okay. I've got a kid who's in his mid-20s who just passed second level of CFA. I'll ask him. Okay, or anybody else with a full-fledged CFA. I'm not I'm not a connoisseur of that stuff, but it means something to me when I see that a profitability grade is sort of middle of the road for its sector. I want that out of the way. I don't want to have to worry about let's call it the stability and quality of the business. Okay, so I hope that helps on that one.
Yeah, I think it's not a big, I mean, I'm losing like $10, so I don't think it's a major deal. But on the other hand, I keep looking at it all the time and saying, why do I have this in my portfolio? So I just feel uncomfortable. So I
Well,
think the best
well, let's
is,
talk about that for a minute because that's really a broader question on portfolio construction and sell rules. One thing that I think I'm going to try to lean toward with the service going forward is, yeah, you'll always be able to see what I own and get an explanation of why I own it. But what we won't have in there as much of is hyper focusing on the nuances of my portfolio at the expense of being able to cover more securities. I mean, you've all proved it today, so thank you. Okay. Of all of the things that were brought in here, for me to chart today, I'm just checking off. I think one of the stocks is one that is sort of like high on my list to consider. Uber's and it's not even that high. Uber's, I mean, it looks interesting, but it's not like, oh, okay, hey, guess what, guys, I'm going to collar this tomorrow. Yeah, JP Morgan, would have been too far gone. So just the fact that there was very little overlap between what you all asked about and what I'm focused on means that this service will be even better than it already is. Okay. If we can give you a lot more ideas because ultimately the service is not about what I'm doing, but it's about using what I'm doing and how I'm thinking and teaching people a lot of these overlooked but extremely valuable in a dollar sense in a bad market or a mixed market uh, features and factors of, let's call it, comprehensive management of your own personal portfolio. Other questions?
okay, thank you.
Somebody else, I think, unless it was feedback, did somebody else have a question, or are there any other tickers? Okay. Well, then we have two choices. I've got I don't know, about a dozen names. I probably will just click through on a screen because they all kind of tell different stories, some related to these, but a bunch of different types of charts. Or we can call it quits. Give me a thumbs up or something if you want to keep going. Otherwise, we'll call it a day.
I'd like to get your comments on gold, if nothing else.
Yeah, I did mention that like 3 times and never came back to it. Okay. Good. So, gold, I like gold more than I have in a long time. That's not saying much because I usually hate gold. And let me just stretch this out to a weekly. Okay. So here, I will give you, it's got to be easier to see this. Okay. I'm going to give you some of the highlights of what I just talked about with these guys on the Seeking Alpha podcast. So here's the thing about gold, and this is IAU, which I bought. Okay, GLD might be a little easier one to track. Okay, so if you look at this chart, you'd say, wow, look at that. Look at this. It pulled back. I mean, it took, a few months. It pulled back, and now it's just bust through an all-time high. Gold closed, I think, an all-time high today. All right. It looks a little stretchy, but it's not bad. Okay. But then we go to here and we realize that from here to here, it went nowhere. You see that? How long is that? About 12 weeks? No, 12 years. 12 years. In fact, since I didn't get to use this on the podcast, you guys can bear with me. I'll run this line by you, okay? So gold happened to peak just about to the day of when my wife and I celebrated our anniversary in 2011. If I had bought her a piece of gold back then, 12 years later, if she had said, hey, I was thinking about selling some of my gold. Yeah, probably gone up so much in price, right? No, it was worth the same 12 years later. Okay. To me, this is what happens with gold. This is what happens with a lot of securities, a lot of stocks now, this zero return club that's got a lot of members. However, when something comes along, it could be that people are worried about stagflation. It could be that the shine is worn off of Bitcoin. So instead of the new gold, they're going back to the old gold, which is gold. Don't know. I never try to figure out the reasons. I'm always try to be aware of what the reasons could be for the narratives. Gold does not look cheap by any means to me, and why should it be? It's had a tremendous run. But one of the things I figured out is that it had, and it's not just gold, it's the gold stocks, okay? Let's see if I can pull up my notes from that. Here we go. Okay. So yeah, you're going to hear that gold is up 40% in the last year, and that is absolutely true. But like I said, the 12 years prior, it was about flat. And so doesn't that kind of tell you who it is? Who is gold? Gold is something that is going to have its runs. It's all about what it was thousands of years ago. Gold is whatever people will pay for it. Now, you could say the same thing about a business, but there's not much intrinsic value. There's, I think, a very small amount of gold on mobile phones and things like that. Okay, there are commercial applications, but they're limited. Silver has some more, but it's not like an industrial metal. That is the reason for me that gold is always a rental. What some people do is they say, okay, I'm going to buy the gold stocks. My bottom line on gold stocks is that, hey, I'll buy anything that looks good. Okay. I mean, I was taking a look here, probably should have done something with it, but you know, like I said, I can't get to all of them. What I'd rather do in the service going forward is say, hey, here's a bunch of things that look good to me. I don't know which ones I'm going to buy, but they're starting to look better, and just kind of do it that way. I love feedback from subscribers or potential subscribers, you know, about that aspect of it. So right around here, trend was changing. This is all looking pretty good, and this, you know, that's 15% I probably could have had, but didn't. But you know, that's going to happen. But here's the thing about GDX, which is the gold miners, and any other gold mining ETF or an individual gold stock. Sometimes it's treated like gold, and sometimes it's treated like stocks. And so you have to be aware of what the market is rewarding. If the market loves gold and loves gold stocks, which, you know, give it the benefit of the doubt, those two things are true right now, good for gold. But if the market sours on gold, gold stocks, it's what they mine. People tend not to look at them as businesses the same way they do others. It's a proxy for the price of gold in a corporate vehicle. And you know, what if the stock market is doing lousy? Well, gold might do better, but gold stocks are going to have a tough time keeping up. Yeah, and since they tend to be more volatile than other stocks, you can get a cratering like this back in 2022 when this thing was cut squarely in half. Does that make sense? Squarely in half? I'm not sure. Maybe it should be squarely into 4 pieces. Okay, Rob, back on point. So GDXJ is the junior miners. And by the way, don't think that I don't like these. I think they're great. If I decide that gold's going to last for a while and I want a little leverage in what I'm doing, whether it's you know, just using options instead of stock, or just you know, kind of riding along in something that, you know, is pretty liquid but part of my stock portfolio. There's a lot of different sort of ETF products out there for gold and gold stocks. Yeah, this is a little bit more leverage because these companies tend to be smaller. They mine for gold in more speculative areas. They're more hit or miss. So, you know, it's like there's 2 times bull, there's 2 times bear, there's covered rights, covered call writing. There's a yield max ETF, which produces a lot of yield. But the one thing they all have in common, except for the bearish ones, is that, you know, when gold is sinking, it's kind of hard to make money on anything related to gold, and unless it's an inverse. I'm going to cover one more thing, and this also actually finishing an article on this hopefully today. So my recent position in SunGard New York portfolio was specifically this. It was IAU, which is one of the big gold ETFs. And let's see, what was the actual date? 2/3. So right there. Right there. Okay. So I stepped in here. It was only a week ago today. Stock, or the ETF was around 53. What was my plan? Well, my plan was I don't want to get crushed if gold turns back around. I want to spend as little money as possible. And I'm willing to not make any money if it meanders up to about $55 a share. By the time it gets to the expiration date, which is not until the 17th of April. So I was giving myself 2.5 months to try to profit from gold over 55. And the sooner the better, because, you know, time runs away from you, and it decreases the value. So what happened instead? I'll zero in on this. Okay, great. Started off just fine. Gold is up to 55. My strike price is at 55. So technically it doesn't have any value yet. But guess what? that little call option is up 65%, I think, 65% in a week. But I'm controlling what would be the equivalent of a 6% position in gold in terms of the movement above 55. I'm going to have to do, I'm sure, and I can't wait to do an extended session about the basic elements of this. We talked about collars, dog collars. Hey, this is where I say I don't want to buy the ETF. I don't want to buy gold stocks. I don't want to buy anything unhedged. But I also am not at the point yet where I feel like I want to collar it. I want effectively pure upside beyond a certain point, and it wasn't that much higher. All I needed was for gold to go up $2 or about 4% in 9 weeks, 10 weeks, and it did it in the first week. So if it pulls back from here, okay, how much did I risk? I literally spent for every contract 95 cents a contract back here, which means that for every contract I bought, it cost me $95, and I control $5,500 worth of IAU, which means that between now and April 17th, let's just take one glorious example, because the way it's moving, it could get there. Let's say that IAU is selling for, can't even see it on here. Let's say it's $60 a share. It's selling for $60 a share. Well, I have a little ticket that says I can sell it for 55, but it's at 60. So what do you think it's worth? Well, if there's no time left, this happens on April 16th, 17th, is going to be worth $5 a share, because I can sell it for 55 and it's worth 60. Okay. I paid $95 for it, but I can sell it for $500. It's 100 times, it's 100 shares. So I paid 95. I can't lose more than 95 because that's all I put up. But if it even goes to 60, I've profited at least $500. Why at least? Because if it goes there in the next couple of weeks, the market is like, well, wait a minute, it's at 60 and, still got all this time left. There's still 2.5 or 2 months left until April 17th. Maybe it's going to go higher. Okay. This is all, computerized pricing, but if it goes to 60, it's going to be worth more than 5. It might be worth 7, 8, maybe it's worth 10. And now I've made 10 times my money, and it hasn't even gone to that much over where my strike price was. But the key to me is, no matter what happens, I can't lose more than $95, 95 cents a contract, $95. What is my gain? Unlimited. Unlimited for the next several weeks. Okay. Now, I'm going to stop there because I'm sure I've explained it, or as I often do, over-explained it. But I want you to understand how powerful a tool this is because of where interest rates are. What does that have to do with interest rates? Here's what it has to do with interest rates. If you think of this as a barbell, okay? A barbell meaning it's big at one end, it's big at the other end, and there's a skinny part, not much in the middle. That's kind of like saying, you know what? I'm not finding a lot of stocks to buy and hold. So that's going to be the skinny part. There'll be few, if any. What am I going to have on the ends? I'm going to have some collars for sure. It's kind of a replacement for the stocks that would normally have in the buy and hold. I'm buying the stocks, I'm owning the stocks, I'm getting the dividends, but I'm collaring it so my downside maximum loss is defined and my upside is limited, ... but I can change that and make it less limited if I want to. Okay. So that's the collar. What's at the barbell ends? Well, things like this. It could be something I like, and I buy a little call option on it, just like I did with the IAU last week. It could be something I don't like. let's say I decide, I don't know, Bitcoin's going to roll over, or the NASDAQ is toast, or whatever, just giving examples, not specific. I can, especially when volatility is low, I can buy very low cost options, put or call, spend a teeny tiny amount of money. And you know what? As I will rationalize it, I'm not only not paying for it, I'm almost getting paid to do it. That sounds a little bit outlandish. It sounds like hype. Let me explain it. If I have a little collection of very small investments, okay, I'm thinking about doing this with some very volatile stocks too, just taking very tiny positions. But if you have small outlay, unlimited upside, well, last I checked, 1-year T-bills, 2-year T-notes are yielding still in the 4.25-ish range, maybe even up to 4.4, 4.5. Okay. The longer that stays the way it is, the more I can do something like this. Oh, you mean I can get 4.25 for 2 years? Great. I can put a ton of money in that, and now I can do this other tactical. It seems aggressive, except for the fact that I can only lose what I put up, and what I put up is small. That's the barbell. I'm getting an assured return on a chunk of the money, but I'm taking some big shots with small amounts of money. I used to call this macro tracks. Now I just call it part of the Sun Garden Yark portfolio. And so I think what you're going to see me doing more of is, and with the T-bills, I may just use ETFs because it kind of works out the same, just like I've been doing. Okay. The longer we go where things aren't suddenly appearing to be great values, I see having an even bigger component where it's barbelled this way. So you've got a barbell that I just described. You've got collared stocks in the middle, and then the only other main segment of the portfolio would be the high income ETFs, as long as they are productive. If interest rates spike and it hurts a lot of them, that game will be over for a while. If interest rates fall precipitously, that may move more money into them because you're making money 2 ways. You're getting some yield and you're getting some return. Like I say all the time, folks, I can't tell the market what to do. I'm just kind of playing the hand I'm dealt and not trying to force anything, and keep my capital first and then try to grow it as much as I freaking can. So with that, are there any other questions? Otherwise, we'll see you Wednesday and next Monday. All right, good. By the way, if you are a subscriber and you have not left us a, what do they call it? Review? I think it's called a review, recommendation, whatever. I think there's an easy place to do it down and just send something out. For the first few months that you run an investing group, they don't even turn that feature on. But now that people have been in, and I'm certainly not going to tell you what to write, but if you think you can help